Ladies and gentlemen, mesdames et messieurs, nous allons commencer.
Ladies and gentlemen, we're going to begin the conference now. There's quite a bit of a delay at the gate, so people are going to join us as and when they can. But we're going to have to start the conference so that we can make up the time that we've lost.
Welcome. It's my pleasure to... Is it working, the microphone? Is it working now? Okay. So it's my pleasure to welcome you to the third edition of the International Conference TaxCOOP, TaxCOOP 2017. And to open the conference, it is my honor to introduce you to Michael Lennard. Michael is the Chief of International Tax Cooperation at the United Nations. So Michael, please.
Thank you, Brigitte. I'm going to be very short because many of you are still in line, not here, and secondly, in the interest of time. But I wanted to give a very hearty congratulations to TaxCOOP. I know how much effort has gone into this conference, and to the South Centre. I see Butch Montez there from the South Centre, a very important international organisation, and I really want to congratulate them for organising this event in the perimeter of the UN Tax Committee work, a new tax committee and a very exciting agenda which starts tomorrow. Debates on tax now involve more countries, more civil society, including NGOs, more types of business like small and medium enterprises, not just multinational enterprises, more women. There's a lot more women on our tax committee this year. We made a determined effort to make sure that that was possible. And more young people. So it's a bigger debate, and it's the better for that. That enlarging of the people involved in this debate and of this debate about tax cooperation internationally is very well reflected in the program. And I do like that it ends with a forward-looking aspect, not just in terms of subject matter, but also generationally, which I think is particularly important at the moment. I also commend the organisers for addressing some of the trickiest and most nuanced areas of taxation, the ethical dimension, the issue of tax transparency, and the issue of tax competition. They're very, very difficult areas. They're not black and white areas, but they're all the more important for the difficulty. Tax is at the centre of country development and lifting people out of poverty and degradation, helping them to meet their potential for the benefit of everyone. Put in that context, the discussions today and the tax work of TaxCOOP and the South Centre is all the more important, and it's all the more appropriate that it be held in the heart of the UN. So I wish you a good, thought-provoking day and a forward-looking day to lead to a very productive year, leading to the 4th edition of TaxCOOP, wherever that is next year. Thank you, Brigitte.
Thank you so much, Michael Lennard. This was a wonderful opening statement. Thank you so much. You and I, we have been discussing about this conference since 2013. I wish to tell you that the founders of TaxCOOP, the collaborators, and myself feel privileged to be here with you today at the United Nations. Thank you so much. Thank you. Merci énormément à vous.
Thank you very much, our faithful audience of the TaxCOOP conferences. Allow me to tell you that today's conference is going to be broadcast live on the TaxCOOP website, www.taxcoop-conference.com. And we also invite everybody to participate in TaxCOOP via the conference's Facebook page. Last year, we reached 10,000 people with the web streaming of the conference. And without putting any pressure on my colleagues, we hope this year that we're going to do even better and go beyond that figure of 10,000 live attendees. TaxCOOP exists precisely because we believe that in order to succeed in modernizing our tax systems, we need to come together and discuss tax competition and stakes and opportunities surrounding international taxation. There are too few initiatives looking at the major opportunities and challenges of international tax competition and this new momentum created by globalization.
Who accepted to participate to TaxCOOP 2017 and all of our special partners who believe in TaxCOOP and collaborated with us on making this event a success. We have 25 partners at TaxCOOP 2017. Be reassured, I will not mention all of them. But I would very like to mention the Ministry of Finance of Quebec and the Minister himself, Carlos Letao, la Caisse de dépôt des placements du Québec, and also l'Ordre des comptables agréés du Québec et la firme de comptables PricewaterhouseCoopers, who really helped us in making this conference again a success. I also wish to thank my very dear professor from the Harvard Kennedy School, Jay Rosengard. Many of us here today attended his very important executive education class program during the summer, ComTax, Comparative Taxation and Administration, held the last 2 weeks of August. So Professor Rosengard will be here through the lunch, and if you have questions, please do not hesitate to address yourself to Professor Rosengard. Finally, j'aimerais de tout cœur remercier.
I would also sincerely like to thank my colleagues at TaxCOOP. You're going to get to know them throughout the course of the day. And in particular, I would like to mention Louise Otis, Lynn Latulippe, Adam Konieczewski, Marie-Thérèse Dugas, Marie-Josée Kaya, Camille Saint-Seine-Gosselin, Isabelle de Grise, Martin Philibert, Laura Nifan, and Alison Christians. With that, I wish you a very pleasant day, and please don't forget to join us for a drink at the reception at the end of the conference. Thank you very much and welcome.
Mesdames, bonjour messieurs, j'espère que tout le monde...
Good morning, ladies and gentlemen. I hope that everybody can hear me, even at the back there. Gentlemen, sir, can you hear me? I would like to tell you that I've just got a message telling me that the streaming is working perfectly on the website, so that's an excellent message for us at TaxCOOP. Our first panel today is entitled The Impact of Tax Competition on Multinationals, SMEs and Individuals, and it will be moderated by Mr. Guy Mettan, the director of the Swiss Press Club. He's also one of the founders of it. Guy Mettan is a journalist, is the author of several articles published in, many articles published in the Swiss press, and as part of UNESCO's work, he even proposed the creation of a code of conduct seminar for journalists. He is the vice president of the Swiss West Africa Chamber of Commerce and president of the Geneva Red Cross. Please wish a warm welcome with me to Mr. Guy Mettan.
Microphone, please. comme ça? C'est mieux?
That is now working. Okay, thank you very much. So the topic that we're focusing on for this first panel, as has been said, is the impact of tax competition on multinationals, SMEs, and on individuals. And to tackle this topic, it is my pleasure to welcome Ms. Annette Alstadsaeter. Ms. Alstadsaeter is professor at the School of Economics and Business of the Norwegian University of Life Science.
Specialist about all of the problems of tax avoidance, tax evasion, and all the problem of the fiscal matters. She's also member of different institutions in Norway about fiscal and fiscal policies. We have also the pleasure to welcome Martin Hearson. He's a fellow in the International Relations Department of the London School of Economics and Political Science. He's also specialist about the political economy. And on a aussi le plaisir d'accueillir.
And it's our pleasure as well to welcome Mr. Gervais Rufyikiri, former Vice President of the Republic of Burundi, former President of the Senate of Burundi, and also a specialist in good governance and issues relating to economic and fiscal policy. It's important that he comes from Africa, so we are going to have the African point of view presented here. So thank you to Mr. Rufyikiri for having agreed to be with us. And then we have my friend Xavier Oberson, who is professor at the University of Geneva. He is a great Swiss specialist in tax matters and in tax evasion and all matters concerning enterprise taxation.
Floor to the first of our panelists. The idea is to give them 5-6 minutes to expose the facts and effects of the tax competition on the enterprises, and after we will have the opportunity to have exchange and idea and discussion with you. So, Mrs. Alstadsaeter, please, you have the floor. Oh yes. Okay. And I think.
Then no microphone for the speaker.
Better? Yeah.
Yeah. Oh, now it's working. Yeah, I will present new evidence on households' use of tax havens and implications for tax evasion. And this work is joined with Gabriel Zuckman at UC Berkeley and Nils Johannessen at Copenhagen University. And all the 2 new working papers and associated materials can be downloaded online. So the big question is, how big is tax evasion in rich countries and how is it distributed? So the conventional wisdom is that, from what you can observe from random audits, is that it's the poor who evade and the rich avoid. They use legal methods of reducing their taxes, like tax planning, sophisticated methods. But who actually evades and how big evasion is an important question for tax policy, for tax enforcement, and actually also for the implications of inequality, because much of the inequality measures we have are based on tax data and reported income and wealth for tax purposes. But the problem is that it's very hard to capture evasion at the top among the very rich. There's a very small number of the rich people sampled in random audits, and it's also very difficult to observe sophisticated tax evasion using shell companies and using tax havens, because tax authorities can't observe and monitor all the banks abroad, and they often don't monitor our transactions to and from the countries systematically in a systematic manner. So let's turn to the estimates of the global use of tax havens. So we know that among wealth corresponding to among 4% of global GDP is held in Switzerland, in Swiss banks. We have estimates showing that about 10% wealth corresponding to 10% of global GDP is held in tax havens globally. This is basically an underestimate because it only consists of financial wealth, not real assets, gold, arts, and so on. And we have other estimates using different methods come to about the same conclusion, somewhat different level, but it's the same development. So, and if anything, we see that the global wealth and tax havens has increased over the last years, in spite of different measures trying to fight this. So, but where is it actually held? So what we can see is that it's been a shift in from Switzerland used to be the dominant tax haven for household financial wealth. That has decreased somewhat over the years, but it seems to have shifted a lot to Asia, in particular Hong Kong. So there's a shift in the preferred tax havens. We have now new estimates on country-by-country estimates of hidden wealth. And as we can see that even if the global estimate is about 10% of wealth corresponding to 10% of GDP, it's very big heterogeneity across countries, from like just a couple of percent of GDP to almost 70%. So there's a big, this global estimate masks a big difference across countries. What we don't know is who within countries actually own this wealth. And what we will show you now is that we have brand new evidence showing who owns it, and that actually has implications for our understanding of tax evasion. We use new information from Swiss leaks and from Panama Papers, and also from from voluntary disclosure. And we matched this to very extensive administrative tax records in the Scandinavian countries. And there we actually know also that about 10%, only about 10% of the accounts are reported to the tax administrations. So it's not illegal to hold accounts in tax havens, but you are entitled to, you have to report it. And the majority of account holders do not report it, and that's tax evasion. We then use this and can actually find the first information on who within a country actually hides wealth. And it's the rich. So we know that in Scandinavian countries, 80% of the hidden wealth belonged to the top 0.1% households. And it's even more concentrated. Half of the hidden wealth corresponds to the very, very rich ones, like the 0.01% of the richest households. So this is very concentrated. Yes, and we also know that in Norway, about 12% of the top richest households actually came forward and voluntarily disclosed that they had hidden wealth, that they had evaded. So what does this mean for our understanding of tax evasion? Well, it's not only the poor who evade, it's also the rich ones, and the rich, they evade a lot. So when we combine the information we had on the hidden wealth in tax havens and what we know from the random audits, we can actually estimate how much of the payable tax people across the wealth distribution evade. And the average is about 3%, but it increases a lot when you come to the very rich ones. So the top rich families, households, they actually evade 25% of the taxes they should have paid. This has huge implications also for tax revenue of countries, and also should also impact how tax administrations work. Thank you.
Thank you. Thank you, Annette, for this introduction, quite interesting. Now I would like to give the floor to Mr. Gervais Rufyikiri, and after we will follow with other speakers. Please.
Merci beaucoup.
Thank you very much indeed.
Peut-être que ça va suivre.
Oh, because I think that the presentation will come up soon. Ladies and gentlemen, it is a great pleasure for me to be able to speak today about tax competition challenges in developing countries, taking Burundi as a case study. The advantages granted to investors by the governments of developing countries are motivated by several reasons, and the two main reasons are to be in line with international standards, regional regulations, and local laws. So these are the legal advantages or incentives. And then the other main reason is favoritism, favoring one country. So this is corruption and illegal advantages. If I turn to the different kinds of legal advantages or incentives, well, these are regularly granted to investors and involve tax breaks to attract investment. Developing countries' governments are under extreme pressure to improve the business climate, and good performance in facilitating business gives a very good image of the country, which in general is a good criterion to attract investment. Currently, these countries are competing to drop tax rates and other payments which are levied by states on companies. Burundi was accepted as a member of the East African Community in 2007. This East African Community is Burundi, Rwanda, Tanzania, Kenya, and Uganda. Since then, Burundi started the process of regional integration, in particular through several reforms, including modernizing its tax system. If we look at the different administrative and legislative reforms, I would mention the law on value-added tax, promulgated in 2009, a new investment code from 2009 with tax incentives provided for, and a new law on income tax, which was promulgated in 2013. In addition, since 2010, Burundi has undertaken several reforms to improve the business climate. And some taxes were abandoned and others were reduced. The tax incentives for certified approved investors in conformity with the law are the ones you can see up on this slide. Exoneration from customs duties on commodities and equipment to establish new investments. Exoneration from different duties for acquiring property, land or buildings for investment, and payment of rights on products which are semi-finished or finished products for the investment project. And these have dropped these are dropped and decreased according to the amount of investment. The tax advantages include a reduction of 2% of tax rates on profits if the promoter can prove that it employed between 20 and 200 Burundian citizens, and this reduction is 5% if the number of employees from Burundi is over 200. There's also exoneration from taxes for a period going from 1 to several years to facilitate amortization of investment. And there's what we call a tax credit, which is 37%, which is the very foundation of these advantages. And there's also a drop in tax rates for the income of companies of 35% down to 30%. So this decrease has been in place since 2014. The next slide will show you that these new tax rates are competitive in the East African Community. We see that Burundi gets better advantages than in Kenya, for example. And you'll see as well that, and the next slide, please. You'll see other issues which are of concern to us. The illegal advantages and incentives are a matter of concern, but also the lawful but negative incentives. We have seen that. And then the next slide will show to what extent the exemptions and incentives have had an impact. So the extent to which they've been increased, you can see they've gone from 1.7% to 3.4% of GDP. And the next slide shows you the extent to which performances in domestic revenue collection have dropped. And you see on the right the losses which have been registered, so coming up to almost 20%. These tax incentives represent a loss in short term in the income collected by our state, but in the long term, we would hope that this would be beneficial in job creation and in the taxes which would then be paid by these corporations and companies after this first initial period of grace where they are enjoying these tax incentives. So, for the future, what we need to do is to really bring into line registration at a regional level to streamline these tax advantages. We need to work together and also to focus our efforts as developing states on other conditions which could have a considerable impact on investment. So security and stability, macroeconomic stability. Thank you.
Pour ces mots, je crois que c'était très éloquent.
Well, that was very eloquent indeed. Thank you very much. So I now give the floor to Professor Hearson. And then afterwards we will have Mr. Oberson. Professor Hearson.
Okay, I'm just going to wait for the PowerPoint slides to emerge. I don't know anything about taxing robots.
Yet.
Worst nightmare presenting, isn't it? When you
I will do your presentation afterwards.
Great, yeah. Thanks. I have, but if it's okay, I'll ask you to move. Yeah, okay. Great, thanks. Okay, now if we can move to the next one, please. Thanks. So I'm just going to make 3 short points, but this is an overview to those 3 short points. 2 stories that I found interesting in the last year that relate to tax competition. First, something which you very rarely see, which was an OECD country announcing a policy of increasing its corporate tax rate from 22 to 25%, and a proposal that provoked quite a lot of political disagreement within Korea around whether or not it would have a negative impact on investment. And secondly, my own country's continued reductions in its corporate tax rate to the point where actually businesses are now saying that they want the government to stop reducing corporate tax rate because they're concerned that it will damage public confidence in the tax system. So I think but both of those stories indicate the fact that politics in each country plays an important role in the setting of tax policy, and in some ways acting as a buffer towards the pressure that's created by tax competition. So my 3 slides are going to talk a bit about that. So the next one, please. So this is the first point is around tax exemptions, and it follows very nicely from what we heard from Burundi. This just shows some research that I did a few years ago, where I looked in government's own estimates of the revenue foregone from corporate tax exemptions. So I passed through the different reports and I tried to exclude exemptions that were not related to corporate tax, also timing differences. So what you have here is the real revenue foregone from corporate tax exemptions. And there's a couple of points that I think are interesting from this slide. It's expressed as a percentage of the total corporate tax that was raised. So the first thing is the median values. The median amount that this group of 16 countries, which is all the ones I could find from developing countries, is foregoing in corporate tax from exemptions is just shy of 20%. I think that's quite an interesting amount because you can compare it to the OECD's estimate of the cost of base erosion and profit shifting, which is 4 to 10% of corporate income tax revenues. So we can see that the amount that's foregone through corporate tax exemptions is a significant amount, potentially a greater amount than than that's lost to tax avoidance and evasion, which perhaps acquire a greater amount of attention. The second point is about the heterogeneity, so the difference we see. We see some countries where the amount that's foregone is very small, and some countries where it's very large. From what you were saying, it seems Burundi probably is right about the median from this list of countries. And that heterogeneity is interesting because it tells us that something is different between these countries, which, when you look at it, it doesn't seem obvious that there's a particular economic reason why that might be. And one of the main reasons is likely to be politics. What we know from studies of corporate tax competition is that a range of political factors can influence the extent to which governments, which feel under pressure to compete with their tax system, are able to implement the tax cutting reforms they might want to do. That might be to do with the political debate inside a country, which makes it difficult to be seen to be reducing tax on companies if the likely impact of that is increasing tax on ordinary people or increasing or reducing public spending. Another implication is political leanings of parties. So in South Korean context, you have a left-wing party which wants to raise corporate tax and a right-wing party which opposes it. Another issue is the number of veto players within a political system. So in the US, I think, which is the classic example of a country with a significant veto player situation within its policy making, it's difficult for a government to change corporate tax policy because of the need to gain agreement from different and opposing parties within the system. So what that tells us is that domestic politics is an important part of what leads to policies in response to tax competition. And the second part of the difference between these countries is who reports and who doesn't on the revenue foregone. So I found 16 countries that produced these reports. The detail in the reports was quite varied, but I think one thing that we can see from the fact that I could only find 16 is that some countries don't report this information. And if there's to be a proper public debate on the cost of the revenue foregone from tax exemptions, then this information needs to be made public. And so I think the countries that don't report on this as part of their budgeting process should learn from those that do. Next slide, please. My second point was about tax treaties. One type of expenditure which you don't find in corporate tax, in those revenue foregone estimates that I showed you, is the revenue foregone from tax treaties signed by developing countries. And yet when they sign tax treaties, very often countries have in mind that these treaties will act as an incentive. They will entail a revenue cost, and in return there's a hope that investment will come in. So my second point is that if we're to see more effective public debate around the corporate tax system in developing countries to help act as a buffer against the pressure of tax competition, then we need to also have more disclosure of the likely revenue foregone from tax treaties. I know there are reasons why those involved in the negotiation of tax treaties feel this might be only a partial bit of information. It's difficult to really estimate the costs and benefits, but nonetheless I think that disclosing what we can, like we do for other tax incentives, is important. This slide just shows you that even within treaties that are being signed, the withholding tax rates within them are falling, which indicates an increased revenue foregone from treaties signed more recently compared to older treaties. Next slide, please. The final point I wanted to make is about tax competition between capital exporting countries. So this chart shows income from foreign direct investment by British firms over the period 2005 to 2010. And what you can see is that in 2009, the green and blue lines crossed over. So there was a fall in the amount of income British multinationals were reporting from reinvested earnings. That's earnings they didn't repatriate, and an increase in the amount they did repatriate as dividends. Now, the reason for that, it's argued in the paper that I'm citing here, which is an IMF working paper, is that the UK changed its corporate tax system at that point towards a system that exempted foreign dividends rather than taxing them also in the UK. So the point they make in the paper is that a change to the way that a capital exporting country taxes its multinational firms can have an impact on other countries that host those firms. And in the study, they show that British multinationals, after this change, became more sensitive in the location of their real investment to corporate tax rates. Similarly, there's other work that shows they also became more likely to shift profits from higher tax to lower tax countries following this change. And the final point to make about this is that the reason the UK adopted that policy and the reason for the rapid spread of territorial tax systems, of exemption systems, is partly tax competition between countries that want to maintain the competitiveness of their own outward investing firms and to attract and retain headquarters of multinational companies. So tax competition by capital exporting countries is also a part of the picture that we should consider. Thank you.
So thank you very much, Martin, for this explanation. It was also very interesting. And now I would like to give the floor to our last speaker, Professor Oberson, please.
Yes, thank you very much. When I see the program of the speech of today, it's the impact of tax competition on multinational, small, medium enterprise and individuals. Maybe in the future, we could add also the impact on robots. And this is what I will try to describe a little bit to you. The topics may sound a bit strange at first. By the way, one of the articles I wrote about this was first refused by a law review, and eventually it was accepted, but it took a while just to show that it's not an easy topic. But it starts from the consideration that you see now robots in every part of our life. In the past, most of the robots were used in the industrial sectors, like enterprise factories, but nowadays you see robots used also in the service economy. You have robot lawyers, doctors, farmers, bankers. In most of the area of the economy, you see more and more these robots entering into the scene. Now the question is, what will be the impact on jobs of this development? I know this is quite a controversial issue. There are two really lines of thinking. One line of thinking is to say, this is a new industrial revolution. We already had 3 of them in the past, and this development did not really destroy, at the end, jobs, but it created new ones. If it is true, I think I could end up my presentation right now. But the question is that there's a second line of thinking. And the second line of thinking is to say, well, this time it's the 4th industrial revolution, and for the first time we see machines, robots, but they have the possibility to think, to make decisions, to increase their capabilities, and to learn, and to become eventually autonomous. So if this line is true, we may see, in fact, a huge impact on labor, and there are various economic analyses that support this perspective. So my point is not to say which one of these 2 lines of thinking is the right one. It's just to say, if the second line of thinking is right, we should think about it right away, and we should try to design a solution to that. And why is that? Because if this huge loss of labor occur, you could have what I call a double loss situation. First of all, you would see all these wages disappear, and wages are subject to social security, are subject to income tax. And secondly, you have an additional negative effect, because these people would be out of the labor market, so they would need additional social security, pensions or payment. So you have this compounded effect. In parallel to that, what is quite interesting is that some analyses have started as a parallel analysis to think about developing a legal capacity for robots. You have the Parliament report of February 2017, which tried to design a sort of economic, or I may even say electronic capacity, legal capacity of robots. This report focuses more on the civil law aspect, like responsibility of robots, possibility to enter into contracts. And you have the discussion which started also this year, basically, and last year among scholars. And when you start also to think about legal capacity of robots, if you allow me to quote John Lennon, you can say, here comes the tax man. Because when you think that a robot can become a legal entity, like a corporation more than 1 century ago, maybe one day you can even imagine that the robot as such could become subject to tax. And this concept could be a solution to solve these huge losses that we could face on the social security levies on wage that could disappear. Now, to go into that, you need basically two two consideration that should be made. Next slide. First one, you need an economic reasoning behind the idea of taxing robots. And secondly, from a tax and legal standpoint, you need a constitutional explanation, a constitutional reason based on the so-called ability to pay principle that should justify, as such, taxing of robots. We don't have the time, of course, to go into this development, but let me just make a little comment here. Under Swiss law, if you are the owner of a house, you have to pay an income tax on an hypothetical rent that you should have paid if you were renting the house. Okay, this is what we call an imputed income. Now, if you make the same reasoning with the use of a robot, you have a company using a robot. Instead of paying a salary to a human worker, it doesn't have to pay this salary because it uses a robot, which can even do the job in a better way than the worker. Don't you accept, at least as a reasoning, that there's an economic aspect to that? There's like an imputed income to the enterprise which spare the salary that it should have paid if it were to hire the worker. This is what I call the neutrality principle between a human worker and a robot worker. So this would be one of the ideas, one of the economic reasoning and constitutional reasoning, which have been, of course, developed much further, but just to put the point in perspective. Now, if you go further, then you should think, okay, how are we going to implement this tax? You can think about the corporation tax, a tax on corporation. You could think on an income tax. You could think also of a value-added tax because some consumer will use the services or the supply of goods used by robots. But the last comment I want to make here is that what I'm saying maybe goes a bit too far. It goes too far at this particular stage where we are. And my conclusion would be that right now, as such, the robot, even if it becomes a legal entity, would not have an ability to pay because the robot has no money. So at the first stage, what we could consider is to tax the use of robots under the reasoning that I described before. But if we go further in the future, but this is the second stage, maybe 20 years from now, you can even consider, and some people are thinking about that the robot as such, as a new legal entity, could also have a sort of capacity and ability to pay. And then at this second stage, maybe you would have the robot becoming itself, if I may say, the taxpayer. So a conclusion, a first stage, maybe a tax on the use of robots as a sort of economic ability to pay, and a second stage, a tax on robots as such. So I'm sure there are other possibilities to discuss and to think in the future. Thank you very much.
Thank you very much for this overlook on the future. I think the future is already there, so we have to think about these possibilities because we have seen with the GAFA, we didn't tax them, and now it's a huge and massive tax avoidance and tax exemptions for the internet companies, but same now with the robots, if I can say. So thanks again to all our speakers. Maybe I have one question to start. As the argument to justify the tax exemptions and the lowering of all kinds of tax and fiscal pressures, as also Mr. Rufyikiri has explained. So, do we have instrument of measure of the positive effects of the tax exemption or not? Because I have the intuition that it's a kind of ideological argument, but without factual evidence. I don't know, I am not a specialist. So do we have some, yes, concrete measurement of the effects of the lowering of the taxes on the economic development and so on? Maybe Mr. Rufyikiri and other speakers.
Oui, il y a des évidences.
Well, yes. Few things are clear. First of all, the increase in exemptions represents a real loss in terms of potential revenue. And also, studies have been conducted in the form of surveys amongst investors, asking them about what their motivations were to invest. And most of the investors said that tax advantages were not the main reason for investing. It was chiefly concerns of macroeconomic and political stability, infrastructure, above all energy, and sufficient and a good quality energy supply, and then also markets, sources of commodities, and so on. So there are other factors that need to be worked on. But states that have difficulties in creating good conditions around those important aspects, such as Burundi, it's going to be much easier for those countries to get rid of taxes, but that's actually not what they need to do first of all. Countries that have created good conditions in other areas that I mentioned, those tax advantages, those tax breaks are going to then attract investments and will be beneficial.
Alstadsaeter, about this topic, do you? Oh, Professor Oberson, yeah? Yeah.
We had a sort of similar situation in Switzerland, because we have 26 cantons, and to each of the cantons, they levy a corporate tax, donc une taxe sur les sociétés. So there's a competition. It's like a little Europe, you may say, in Switzerland, and it's a good sometimes we say it's a good laboratorium, you know. So what we did, we had a harmonization law, and I think that could be an interesting aspect from your description, where you say the same base of tax should apply to each of these corporation tax, but the rate is free. So what happened, in fact, is that people would fear that there would be a race to the bottom because the rates are free. But in fact, it did not really occur. There's a sort of range that stayed. And I think it shows exactly what you say, is that at the end of the day, what is also important is the infrastructure, the system, and no cantons went to put a 1% rate of tax. There was a sort of range. So maybe a combination of the two.
We have to consider the research is I think not clear. There is research which seems to point quite firmly towards the idea that many of the tax incentives don't seem to have a positive effect, may even have a negative effect in terms of crowding out domestic investment, for example. And then there is some research which perhaps points a different direction. But I think we have to consider the counterfactual. Is the counterfactual that an individual state doesn't reduce its corporate tax rate, doesn't introduce tax incentives? Or is it that there is some kind of harmonization so that no states are engaging in that? The problem is that states are in a prisoner's dilemma where it's very difficult for one state to hold out if everyone around it is engaging in competition.
Comment?
The problem is not just the levels of the taxes, it's also the implementation. Because also, since you have different states, it's also very difficult for the tax administrations to get information about from what activity from other countries to control that the companies are actually following the tax rules and the transfer pricing rules and stuff. So this one thing is that the rate and the race and the bottom and competition, but the problem will not be solved unless we actually harmonize rules and have information exchange.
Maybe a second question before to give you the floor. It's en français la théorie du ruissellement.
It's the trickle-down theory.
The liberal economy explained that the most richer you become, so you have a big wealth, but this wealth is spreading, is yes, going down in form of investment, or is also spread for all the people. But I have the impression that's only a moral justification, but it's no effective. Or is it effective? That's my question. I don't know in English the théorie du ruissellement. Huh? Yes, exactly. Is it effective or not? Maybe Mr. Hearson. Yes, that's your.
I mean, I can't pronounce on the evidence. I haven't reviewed it in detail, but what you do tend to see is, I mean, you look at my own country, is that pre-tax incomes are becoming more unequal, and actually post-tax incomes, depending on how you measure it, are in some ways becoming less unequal. So the tax system is the thing that is redistributing, not the economy, it seems, not the trickle-down effect that you're describing.
No, Monsieur Rufyikiri.
Mr. Rufyikiri. I think you're right there. These tax incentives could encourage the larger businesses compared to the smaller ones more. As I said when I referred to the figures, the more you invest, the more incentives and advantages there are that allow you to sell things more cheaply and make you even more competitive compared to other businesses, because you have less to lose. In the case of Burundi, we've seen cases in which tax incentives, above all for mining, for example, when there is a company that comes with a lot of resources and then tries to acquire exemptions and incentives over a long period, the risks that come from selling things cheaply are then going to harm smaller businesses. When I was vice president, I had to go to the revenue office to ask them to reanalyze the law to see whether we could not give the same advantages to smaller businesses, because otherwise they were going to be forced out of business. But concerning these tax advantages and incentives exclusively, well, everything depends on policy. There was a case where the opposite happened, and the fees for renewing the licenses for telecommunication enterprises in 2013-2014 were 50 times more expensive than the price that was paid for those fees 15 years previously. And this meant that the small companies, the small enterprises, I mean, everything is relative, but the smaller ones compared to the bigger ones, there was one that had to shut down completely because it was not able to pay those registration fees. And the two other biggest ones had to merge to operate on a single license. And this meant that so sometimes big taxes can actually kill off your tax revenue, so you need to find a balance between the two.
Good, thank you. So I will open the floor to you. If we have some question to our panelists, please, you can just push the button. Don't know who will. Yes, please, Mr. Yeah.
Can you hear me?
Yeah.
My question is for Professor Oberson. Do you see a difference between the robot as a legal entity and the corporation as a legal entity, which is also a source of capital? And we do tax capital, but capital is taxed at the corporate level, it's taxed at the shareholders level. So do you see really a difference, a standalone process through which we would tax the robot as opposed to the standard process through which we're currently taxing capital?
It's a very, very good point. More than 1 century ago, we recognized the need to create a new entity, which is a legal entity, and nobody is challenging that today. For us, it's obvious today. But when you think about it, Have you seen an entity? You know, it's a legal fiction. It's a brand. We see the brand of the corporation, but we don't see the corporation as such. And behind the corporation, you have shareholders, you have workers, you have directors. And then we decided to tax, and it took a while, we decided to tax the corporation as such, and this became the profit tax. And of course, when you start to do that, you need to think, okay, but if I levy the profit tax, I should not tax twice this profit, which then will be distributed to the shareholder or paid as a salary to the worker. And we come into this very thick literature about who is bearing the cost anyway. So now if you start to do that with robots, we should also think about this issue. If you start to levy, and again, this would be, in my perspective, the second stage. The first stage is just to tax the use of robots, which is different. The first stage, if you tax the use of robots as a sort of imputed salary, then it taxes the corporation. So it would fit into, let's say, the corporation profit tax. But if you go to the second stage, it's become quite interesting because we would need, of course, to think in the same way, to say, okay, but now we levy a tax at the level of the robot, which becomes a new entity, and of course we should think about the global system and not create new double taxation, multiple taxation. And I'm not talking about the transfer pricing issue when you start to, I don't know, favor a robot, pay him too much or less, and who knows, maybe the robots, they all go to Monaco. It's a joke at the end, but just to try to answer. Good point.
Thank you. Thank you. Another question, thanks. Or comment? Oh, yes, please.
Okay, you can hear? Okay, so I'd like to address points raised by both Mr. Rufyikiri and Professor Hearson about tax incentives and the cost. I think it's very easy to identify the costs. And another word for those costs are tax expenditures. You're giving up a lot of revenue that would provide you with the resources to actually deal with the binding constraints of lack of investment. And so my question is, are you giving up something you don't have to give up with the tax incentives while taking away the tools that you need to really attract FDI? If you talk to investors, for example, in Burundi, it would be issues of basic hard infrastructure, governance issues, productivity of labor, political stability, nothing to do with the tax code. So the investors would be there anyways and others wouldn't, and what you're doing is you're discriminating against your domestic companies, and it's not clear you're actually attracting any net new investment. It goes to the theme of tax co-op. This is called tax competition, basically, which is driving, I think, counterproductive tax incentives. So I understand the political imperative to appear to be doing something to attract FDI in Burundi, but stepping back and looking at it more from a cost-benefit analysis, in the end, do you think you're giving up a lot more than you're receiving from the tax incentives while creating a lot more inequity in the process?
Monsieur Rufyikiri, et puis après.
Mr. Rufyikiri, and then Professor Hearson after that.
Effectivement, en analysant.
Well, when we look at the relationship between a tax setup and the costs, as I indicated, tax incentives that are above all dictated by conformity with international norms and standards, although this is done at the sub-regional level, this involves costs above all for the poorest countries, because those poorest countries have so many other challenges to face that these tax incentives do not always bear the fruit desired. For example, in Burundi, in 2015, the country entered into a period of socio-economic crisis, and the economy collapsed, and no investor wanted to invest, and many slowed down their investments or shut them off completely. And that's all to say that there are other aspects that need to be worked upon. The laws that we have are modern laws, so the laws are not necessarily discriminatory in and of themselves. They've been implemented with the support of international experts and on the basis of the best standards. And so there's no discrimination at that level, but there's lack of discrimination, and there can also be positive discrimination, in fact. And so the risk is that Burundi's companies struggle to emerge, so we struggle to get a national industry. And this is something that exists not just in developing countries. Liberalization and globalization, generally speaking, holds back and limits the development of local initiatives and entrepreneurship, because people can move in with vast resources and stifle anything that comes from the grassroots. Thank you.
Your son, please.
I guess, because I think that answered most of what I would say. But I mean, I think we have to, you know, we have to bear in mind that there are potentially some benefits from tax incentives at some point in time. The challenge is to know when. And I think that begins with better reporting, better disclosure of the revenue foregone. I don't think cost is the right term. I think revenue foregone, because it's less loaded, given that potentially if an incentive brings in investment and it does, and there's still some tax revenue from that, the costs are harder to quantify, but the revenue foregone is known. So I think we need better data on that side of things. And now with the introduction of dynamic scoring to try and help us assess how to try and build in the investment effects and the economic effects of tax policies into our revenue estimates, we can perhaps be better at knowing that. I think that's a challenge for developing countries, but it's also a challenge for developed countries.
Thank you. Still time for last question, so I don't know who will... Oh, yes, please. There is a small light, yeah.
Microphone, please, for the speaker.
Thank you.
Thank you.
Thank you. Professor Oberson.
Try to consider it on a sort of a global perspective and to start to implement. Yeah, it was difficult to hear.
Not sure.
Yeah.
Yes. Hello, hello.
Yeah.
Okay.
Sorry, yeah.
Sorry, let me repeat. So, going back to your point on the robots, on a macro perspective, especially in a tax environment that includes robots, that would be able to revolutionize the financial sector with economics and banks and the financial sector in general, we must be keen about changing and reformating, regulating the different elements that makes up the society. When you're mixing the elements with technology, because technology is it's a form of society that's growing at a rapid pace, how can we start implementing these solutions? When are we going to do it? How can we do it? What are the bullet points that we can focus on? Because I know we have the two phases, but when can we start doing it instead of keep going about it? Thank you.
So, the implication of robots, of course, goes much further than just the issue of tax. So this is just ancillary analysis. So I take your point absolutely. The issue there are absolutely enormous, and we should try to consider them right now. There are many forums, there are, at the EU level, they are also thinking about it. This raises ethical issues, it raises psychological issues, not only of technology, and so very often, I may say, the lawyers, they come after. And I think this time we should come all together, because the issues are so enormous that we need to implement and to think about them very rapidly, very rapidly. If you take the example of tax competition, exchange of information, BEPS, etc., it took decades to get to a sort of solution. The OECD report on harmful tax competition is of 1998, 20 years ago. And now we are implementing the BEPS program, and I think rather rapidly, but the beginning was even before 1998. Exchange of information took at least 10 years to implement. So this is much wider in scope than this issue of transfer pricing and of exchange of information. So you are absolutely right. We need to consider them, where probably the United Nations would be a right place. The OECD is already thinking about it, but if you take action plan number 1 of the BEPS program on digital economy, honestly, it's a bit disappointing, because you can see all the discussion among the states, the controversy, the competition. It's very difficult to reach to a significant step on, for example, taxing the digital economy. But taxing the digital economy is even much beyond what we are talking about here. Taxing robots would be even more important. And if you look again at this report of the BEPS program Action 1, there's a quote about robots, but they say we should in fact increase incentive in favor of robotics. Honestly, personally, you understand that I take the totally opposing view, because if really we see robots replacing jobs, okay, I didn't expect that, but if really the job bot will take thousands and thousands of jobs, we need to do something about that. We need to do something about that. Okay, thank you.
Thank you very much. So I think it's time to close this first panel. We can applaud our speakers. I think it was quite interesting debate. So thanks again to all our speakers, and we will now give the floor to the second panelist. So thanks again.
Microphone, please.
Alors, merci à tout le monde.
Thank you, everybody. Our next panelists are just taking their seats. Fantastic. The next panel is called Tax Cooperation, Experiences and Challenges in Africa, in collaboration with the International Organization of the Francophonie. We are honored to go through this excellent cooperation with the OIF, and we've already had the pleasure of working with them on the Tax Co-op conference in the past. We'd also like to welcome Ms. Laurence Anmou, who is with us, and today's panel is probably first in a series of panels to come in the future. We also have the pleasure of welcoming Mr. Matthew Martin here with us, just next to me. I didn't know whether to say Matthew Martin or Mathieu Martin, in fact, but he said that either one is fine. He's the Director for Development Finance International. He also worked in the past for the World Bank, the Overseas Development Institute, and the University of Oxford. since 1991 has been advising developing countries and international organizations and donors when it comes to financing for development and debt relief. We couldn't ask for anyone better than him to moderate this panel. So you have the floor, Matthew.
Merci beaucoup.
Thank you very much. Okay, so we're going to start this panel by explaining a little bit why the Organization of the Francophonie wanted to organize this particular panel. Well, some 7 years ago, OIF created a network of ministries for finance of low-income and middle-income countries, which are French-speaking countries, looking at development issues every year, and then work to lobby international organizations on issues relating to financing for development. 3 years ago, the Minister of Finance from Senegal took the chairmanship of this network and said, we're only going to talk about taxes, because for us, we see, as this group of countries, the most important way to finance development is to deal with tax issues. So they mandated a study which we carried out, which, to come back to the previous subject of the previous panel, did not prove in any way any positive impact of tax relief on investment or any demonstration or proof of the trickle-down effect. We saw the opposite, in fact, saying that we should have less exoneration and more progressive exoneration for taxes. That is how you can actually finance development. With this study that we conducted, we also created a database which we intend to update every year, which examines international competition. So each year it looks at the different rates, the different tax structures, and assesses the trends. But we're here today to really give you some good news. This is why I think TaxCOOP asked us to hold this panel. The good news is that, in general, this group of countries, which is resilient, is resisting international competition and holding its own. When we look at the tax rates, it's about 30% for corporate and individual income tax. When you look at Asia and Latin America or English-speaking countries, they're about 5% less, the tax rates. But it's not 100% good news. There's a reduction of about 5% amongst these groups in the rates over the last decade. And we're going to hear about the problems encountered in tax exoneration and in tax evasion, which have meant that collecting taxes and tax pressure is only about 20% of the GDP on average. So there's some good news, some positive points, but there's also a constant fight against international competition. And these countries suffer three kinds of pressure, I would say. National pressure, when they try to change their tax systems. The private sector pushes back, sometimes against this idea. Even if the private sector doesn't need exoneration, there's still some groups, the Chamber of Commerce and so on, which will resist. Then at regional level, we're going to hear from UMOA about efforts to counter possibilities of one country having a competitive approach of lower rates compared to its neighbour. And then international, as has been mentioned in the previous panel, there are international treaties and tax exonerations requested by donors and by development organizations and agencies, and systems of the world, like the World Bank's doing business study. All of this encourages a drop in taxes and exoneration from taxes. So we're going to listen to the statements from countries in Africa to hear how they resist these three kinds of pressures. I'm going to give the floor firstly to Mr. Ismaïla Diallo, who is current Deputy Secretary General of CREDAF, which brings together all of the French-speaking countries, bringing their tax administrators together. Ismail was with us in the network, supporting the Senegalese government whilst they were chairing the group. and he was a tax inspector as well within the Senegalese tax administration. He's had that post since 2005, so he has a good overview of the situation. I'd like to give him the floor to introduce the topic to us.
Merci.
Thank you, Matthew. It's an honor and a great pleasure to be with you today. Firstly, I should thank TaxCOOP and the OIF through the network of Ministries of Finance of low-income African countries for having given us this opportunity to take the floor today on this matter of such key importance for us, which of course involves mobilization of domestic resources as well. Next slide, please. So, this is the structure of my statement. Firstly, there's an analysis of the impact of tax expenditure, because I've structured my statement on the issue, on this particular issue, which is part of tax incentives. We talked about tax competition in the first panel, which can be destructive. This race that developing countries are involved in to drop taxes, in particular African countries, in order to attract foreign investment. And then secondly, I will turn to the prospects for cooperation between African countries, ways in which they can coordinate their tax policies. So, for a very brief introduction to the context, as you know, we are in a global context with a strong consensus as to the importance of mobilizing domestic resources for financing development. And I would recall the Addis Ababa Action Plan and the SDGs. The context is also marked by more demands from our citizens, from our governments. They're more demanding, they're calling for more transparency, more effective government action as well. But paradoxically, in this context, we have countries which are continuing to implement tax incentive policies which aren't really in line with the requirements for efficiency and efficacy. So there's this real need they feel to attract foreign investment and to avoid other countries winning out in terms of regional competition or sub-regional. Doing business is highlighted here. There's demands for tax exonerations from international organizations, such as from the World Bank Group. All of these factors push countries to enter into competition in granting ever more tax advantages and incentives. So the countries seem to still be guided by the concern to attract investment, and they're really involved in this race to drop taxes, and this is putting in jeopardy their public finances and policies. And we have a guide, a handbook, established in 2015 to assist decision makers in tax matters. It's available on the website of CREDAF. It's our belief that this guide, this handbook, is a first step towards fighting against this tax competition. First of all, you need to assess the situation, to evaluate it, so that you can see the full scale of the issue, to look at all that is at stake when looking at tax competition. So you need to do this to really fully assess the impact of different tax incentives and to take the right measures. Next slide, please. In its introduction, the guide, the handbook on tax, mentions the fact that it's important not only to evaluate tax expenditure, but also to publish this information periodically to assess the impact on the state budget and also to launch a democratic and transparent debate on all choices relating to public finances, including tax exonerations. So you see, firstly, there's the issue of assessing the impact, and then there's the issue of transparency in fiscal policy. These are two key aspects which have motivated us to publish this guide, this handbook on tax. So there's the assessment, which is dual in nature. It's a budgetary assessment, but also an economic assessment to see whether the objectives, which are economic objectives, are met. We're seeking to attract investment, to have investment in the economy. So we need to assess this. We need to assess the impact on the state budget and on the economy of the country. So that was our starting point for us in combating tax competition between countries. This evaluation, this assessment allows us to assess the impact of different measures and to streamline and coordinate. Next slide. To analyze the impact of tax expenditure, well, we've seen tax expenditure really increase in Africa. When we've looked at our members and how they answered, we saw, for example, in Morocco, the number of tax measures went from 337 in 2005 to 402 in 2014. In Senegal, it went from 308 in 2008 to 327 in 2012, before it dropped to 301 in 2013. Next slide. To turn to the impact, well, we see that the tax expenditure at the time where we drafted this guide or handbook was 64% of tax income in Canada, 40% in the US, 70% in France, and 17% in Morocco and in Senegal. But in Senegal, the last report for 2013 has transformed the figures to be 40%. So we see that this is 40% of Senegal's tax income in 2013. I'll come back to these figures in just a few minutes. If we compare this to the GDP, we see that in Canada, the figure is 11%. In the US, you can see the figures here. France, 3.8%, Morocco, 3.7%, as in Senegal as well. In my country, it's not an exhaustive valuation, but we can say that the real amounts are higher than this. Next slide, please. In Senegal, the mining code represents a major part. So multinational companies are benefiting from these tax incentives. They're the main beneficiaries. Next slide, please. Then if we look at action to be taken and prospects for African countries, well, apart from this handbook on tax expenditure, CREDF recently published a guide on corporate tax for companies involved in the mining industry. This is an important tool for tax administrations of member states, and we've been working with OIF, UNDP, OECD, and others, the World Bank, and there's been technical assistance provided, which is tailor-made depending on the needs of different member states. Next slide. Recently, we held consultations during the Lomé International Colloquy in 2017 to look at how we can assess priorities, and we have a summary which will be published on the CREDF website. Next slide, please. To look at the prospects, well, firstly, is to step up our efforts to strengthen capacity for tax administrations of member states to make sure that they can improve their tax policies in the right way. We need to pursue our efforts to harmonize tax policies. And we've been doing this in UMOA with directives and decisions. Next slide. To conclude, to promote economic activity, as we've seen, countries are engaged in this breakneck competition to drop taxes, and CREDAF has tried to show through different activities, colloquies, workshops, handbooks and guides to contribute to capacity building to combat this frenetic race towards dropping taxes for tax competition. So we welcome all of the initiatives in UMOA and OIF in our network to improve cooperation in tax matters. Thank you very much.
Merci beaucoup, Ismaïla.
Thank you very much, Ismaïla. So now we're going to move to Mr. Mamadou Makhtar Diagne, Commissioner for the Department of Economic Policies and Domestic Taxation of UMOA, but who has also seen the same situation in the Senegalese administration because he supported the minister in Senegal whilst they were reforming and whilst he was presiding over the group. He's going to tell us about what UMOA is doing to combat tax competition between member states. You have the floor.
Merci, Mathieu.
Thank you very much, Matthew. Thank you for having invited UMOA to be part of this session so that we can share our experience with regard to harmonizing tax policies, fiscal policies in our area, and so that we can brainstorm on these matters with eminent professors and representatives of the private sector here today. So to start, this is the plan of my intervention. Firstly, we shall look at the objectives of fiscal harmonization in UMOA, then the legal framework, then the impact of harmonization on tax competition, and finally, future challenges. So a brief presentation of UMOA. 8 member states. UMOA was established in 1994. We have these 8 member states. We cover a surface area of some 3.5 million square kilometers, population of 112 million. This is my advertising slot for UMOA. You can see that we have GDP, which is some 53,000 billion Central African francs, and we've had a monetary union since 1960, and we have a customs union since 2000. The objectives of fiscal harmonization in UMOA is to facilitate the establishment of a common market based on the free movement of goods and services. If we look at the treaty, UMOA had 5 objectives: to strengthen competitiveness of the economies, to ensure convergency of the economies through establishing a multilateral framework, to create a common market with common external tariffs and a common trade policy, and to harmonize sectoral policies, human resources, land planning, and so on. And the 5th objective of the Union was to harmonize legislation of member states and, in particular, tax regimes to ensure the proper functioning of markets. So, the objective is to facilitate the establishment of the common market based on the free movement of goods, services, and capitals to ensure coherency between the fiscal systems of the member states and to allow states to mobilize in an optimal manner their tax income and to reduce the negative impact of tax on the competitiveness of companies and to make sure that we can restrain the tax competition between states. The legal framework is a treaty. I mentioned the treaty, so we can move on from this slide. If we look at customs policy, We have the common external tariff with different categories from 0 to 20%, and we have a community levy which is 1% and will become 0.8% this year and 0.5% in 2019. On domestic tax, we've harmonized indirect tax, and for VAT, the rates are set as a framework and we have a list in the community of different products which can be subject to tax, and we have a framework, and this is on income tax as well. So we have this for excise duties and also for income tax. There is a basic legislative act, which is the regulation of the community to eliminate dual taxing on income, so dual income tax. This multilateral text is one that all 8 states have signed up to eliminate dual imposition, dual taxation, and also to provide for exchange of information and assistance between tax administrations. We have about 20 taxes under this regulation, and we have 14 directives which are then directly applied in domestic law, and 6 decisions which are directly applied without transposition into domestic law. This community regulation allowed us to contain and restrain tax competition between member states significantly. The impact of harmonization has been to contain our tax rates for corporate tax. Some countries were at 40–45% rates, and so we have harmonized this. We've also looked at harmonizing the securities taxes. For VAT, our rates are at about 18%, and for excise duties, in particular on drinks and tobaccos, alcohol and tobacco, we consider about 40%, 45%. And we, I would remind you, are revising our tax regime for taxes on tobacco. Then the impact of harmonization on tax competition. Well, we've seen political gains. About 80% of the fiscal income comes from harmonized taxes. There's greater credibility for harmonization work on tax matters by the Commission. We've seen the community regulations, which are a clear guide for countries to start reforms of their public finances in all states. And we've seen that we are inspired by the work of other international organizations, and the Commission has been part of work carried out by OECD, the IMF, CREDF and OIF on tax matters. We've worked to eliminate cases of dual taxation and on other projects. The difficulties that have been encountered have shown us the challenges for the future in restraining this tax competition. In tax on capital, we see that there's many tax incentives which have been talked about earlier today, and we see there are specific provisions and measures which are adopted for public-private partnerships. Then for VAT, it's similar as well. These are particular difficulties where we are really encountering the greatest challenges in our harmonization work. So this is why we need to assess fiscal expenditure. I won't go into detail here because Ismaïla has already detailed this. And in 2015, we have required states to report on fiscal expenditure. 3 countries have done this so far, according to handbook. And for Senegal, you can see the figures. In 2012, we saw 20.7% as compared to 37.62% in 2009. Burkina Faso is at 25.53%, and Côte d'Ivoire is at 11, 12%. So challenges for the future. Well, we need to make sure we restrain this tendency towards tax competition. We need to work on our community code on investment. This is underway. We hope that it will be finalized by the end of the year, and also to work on our community code on the mining industry. For public-private partnerships, we have provisions underway. We will have a community law on PPPs for all member states. So that's a rapid overview of what we are doing to present UMO's experience in tax harmonization to you. Thank you. Thank you very much. I'd just like to add a few words. Well, ministers have lobbied different international institutions, which has led to two major achievements, I think. The first is an increase in technical assistance for all institutions to French-speaking countries. French-speaking countries were a bit neglected, I think, because there weren't enough people who could speak French, enough experts who were French-speaking. And so there's more technical assistance in combating tax competition. And also the World Bank in April promised the current chairman for Madagascar to review the policy on tax exoneration, to reduce requests for exoneration, and to review the doing business system. And we're working with them to see how we could reassess the doing business criteria. So, with no further ado, I'm going to open up the floor for questions. We only have about 15 minutes for your questions and the answers. Are there any questions?
Merci pour ces deux exposés.
Thank you for those two presentations. They've provided us with a great deal of information about these two communities, these two areas. I have a slightly skeptical question. Bearing in mind that the countries that are members of these communities have historic trajectories when it comes to society, the economy, and the political system, and not just amongst themselves, but also vis-a-vis other countries and institutions. And so my question is, this mimicking of institutions practical? Is what is announced in the directives and the rules and regulations and institutions actually workable in practice? And do assessments and evaluations take into account genuinely local value, or does it completely overshadow and do away with local value? That is to say, what is the basis for these evaluations and assessments that you were referring to? Thank you.
Oui, alors Louise Otis.
My name is Louise Otis. So I've been listening to what you've said about CREDEF and UEMA, and I have a question that's come to mind. So, OWATA, I've participated a little bit in training judges for OWATA. It's an organization that works on harmonizing corporate business law in Africa. Is there any cooperation between OWATA and CREDEF and UEMA? Are they opposing organizations, or do they work together? Because they seem to have more or less the same countries working in them.
Voilà. First, I'd like to congratulate the organizers for having this panel. It's a wonderful panel, and as the saying goes, if you're not at the table, then you become the meal. So thanks for the panel. A question for Mr. Diallo. I think the work you're doing is fantastic. I think the idea of at least trying to measure and evaluate tax expenditures is the first step in making informed decisions, at least from the fiscal perspective. My question for you is, because of the politics of tax incentives, and the fact that despite overwhelming evidence about the negative impact, we're going to still have them, have you considered in your handbook also providing guidance on second best alternatives. If you're going to have a tax incentive, is there a way to design it to do minimum harm? And maybe have to do minimum harm, or maybe have some slight marginal positive benefit. Thank you.
That would probably be my question as well. Donc, est-ce qu'on peut avoir déjà...
So can we answer that one right away? Thank you for showing such interest in UEMOA. First of all, there was the question from the professor about the shared path and trajectory of the UEMOA member states and the risk of mimicry, if I've properly understood your question, and not necessarily taking into account local value. I think at the outset we need to say that there is no mimicry taking place here. These states have been independent since 1960. They've for a while now been sharing a single currency, and they also have similar local circumstances. And their administrations have acquired some expertise in the matter, and they have tax provisions which are often very specific from one country to the next. So the idea of being part of a community and being able to harmonize our policies, in particular our tax policies, is simply something that I think allows us to be stronger. And local realities are definitely taken into account. If I take the example of exemptions for some core consumer products, electricity, for example, in some countries there are groups that are exempt from that, and that is also authorized in the harmonization system under UEMOA. I think that it allows not just for the weakest strata of societies to be taken into account, but it allows that to be done within the provisions of the community. So I think there's no mimicry in that sense. Now, from the international point of view, what we're really talking about is good practices, and there's nothing wrong with drawing inspiration from the best things that have been done in tax matters as in any other area. We also have specific goals when it comes to mobilizing tax revenues and diversifying our economies, and these are very much high on the agenda in our states at the moment. In our states, the administration plays a fundamental role. The mobilization of internal resources is fundamentally important to ensure investment. That is why we very much give high priority to mobilizing internal resources and to lifting the level of tax pressure. We want to achieve a tax pressure rate of 20% within UEMOA. 1 or 2 states achieve that for the time being. But what we need to do now is, through internal measures and identifying specific niches where that can be done, we need to manage to bring those states up to that target level. And there's also the harmonization that I spoke about of investment codes and mining codes, to precisely so that we can avoid that tax competition. I think that that is fundamental. It's also important for PPP frameworks, because there's a big risk there for falling into debt as well. We often have high levels of debt and also at the same time a great need for investment. And so the focus needs to be placed on mobilizing tax revenues and reducing the level of exemptions while having a shared PPP code and framework. On the subject of OATA, there was a question about whether these organizations overlap. It's not quite that, but OATA really works on harmonizing business law, corporate law. And so the scope of what UEMOA does is much broader. It's an economic and monetary union. As I mentioned earlier, its goals are to achieve economies for the 10 states that are more competitive, to harmonize tax policies, customs policies, and also sectoral policies. So, OADA is, well, we share the area of corporate law and business law with that organization. Now, OADA also covers a broader area. It includes Madagascar and many countries of Central Africa, so it goes beyond the countries of UEMOA. But OADA doesn't look at tax, for example, nor does it look into customs, nor does it cover customs. So that's what I can say in response to those questions, and I leave the floor now to Mr. Diallo. Thank you. Very briefly, in addition to the Commissioner's answers to the first question, I would say that for CREDAF, the countries are very positive about this. They're very receptive to the guides that we provide to them, and mostly it's upon the request of countries that we then produce these guides that go on to be very important and very useful. Now we're talking about standards, guidelines, but once again, when it comes to evaluating tax expenditure, it's a methodology that we're providing, and then it's up to the country to adapt that to their local conditions. For example, when it comes to defining the reference standard, the baseline, it's obvious that each country is going to set its own baseline on the basis of the reality in that country. And there are a number of standards and principles that come up time and again, but countries take into account their local realities when it comes to defining and setting their baseline, their reference standards. So there's no problem there. However, there's a need for capacity building that countries very often express because they want to evaluate their tax expenditure, but although we provide these guides, they also want to be supported in the exercise of evaluating that tax expenditure. So there's also a question of and a need for capacity building there. In response to the question about OADA, we don't have direct links with OADA. It's our tax administrations which, through the tax authorities in the tax system, work on those issues. Now, the last question concerned the second stage for tax expenditure after evaluation and assessment. Well, currently, we don't have the development of a second guide on tax expenditure on our agenda, but as part of our partnership with the Foundation for Studies in International Research, we plan to produce training modules on tax expenditure and also rationalization. And this is a rationalization that will allow for a definition of a tax policy that is more adaptive and more appropriate, but also takes into account developments that may arise. Because what needs to be done is tax institutions need to be set up so that they respond to the needs and goals of the country, but also which take into account requirements of effectiveness and efficiency. And this means that everything related to tax competition is going to be dealt with upstream. And I think that the rationalization of tax expenditure will make it possible for that to be taken into account. And then the next stage, I would say, is rationalization. The idea is not to get rid of everything, but rather to have measures that are based on sound evaluation. And then with evaluations that take place as we go along fairly regularly. If we are not going in the right direction at a certain point, one tax expenditure measure can be ended. I think that that is the most important thing, to integrate public policy into tax policy conduct. Thank you very much, Ismaïla. So I can see that we're almost at the end of our time. I just wanted to say a couple of things. First of all, allowable, permissible exemptions, and those that are more justified on the basis of the studies that we conducted over these 30 countries. I think there are two types of that. First of all, there's an exemption that makes the tax system more progressive, and that's very often something that's done for VAT, exemptions on products for products that most of the population consumes, and that's the case for most countries in Africa and UEMOA as well. And then the second, as has been indicated by OECD and IMF studies as well, and this could be the case in very specific areas such as promoting capital investment, and as was said in the previous session, encouraging people not to use robots, but rather to use human workers. There could be some justification for incentives there in those cases, but they should very much be limited. And the second aspect I wanted to conclude on is that we have spoken here about countries' efforts and the efforts of regional institutions to change this. But right at the outset, we understood that we can't do what we want to do in economic policy terms without the support of the international community. I'm not going to name the country in question, but very early on in our collaboration with Senegal, we were told the story of a country whose ambassador came, accompanied by a large mining company, to say that if there were no total tax exemption for that country coming from his country, then Senegal was not going to receive budgetary assistance from that same country. I find that absolutely shocking. And so that is why I focused on this aspect of international cooperation. If international institutions don't change their behavior in terms of doing business and exemptions, and if donors don't change their behavior either, then the vast majority of exemptions are going to continue in those countries, because this is not an independent decision taken by a single country. This is a decision that they are pressured into by the international community. And so, whilst underscoring the efforts made at the regional levels, we also need to underscore the need for global partnerships to support countries. Just to say one last thing on this matter, during the General Assemblies of the IMF and the World Bank, the Ministries of Finance of low-income Francophone countries, in their communique, and the World Bank was present at these meetings, well represented, they asked for a lifting of the request for exemptions on projects from the World Bank. And the second point in that communique was to review doing business indicators, in particular when it came to tax matters.
Merci beaucoup.
Thank you very much, and thank you very much to the Francophonie for helping the organization of this very important panel. We are a little bit delayed now, chiefly due to the registration that took a little bit longer than we thought. We had a 15-minute coffee break planned, so it would be much appreciated if you could come back at 11:55 at the latest, because then after that we'll have a very interesting discussion on tax transparency, which is going to last about 1 hour and 15 minutes. So we will start that a little bit later. We might go on a little bit into the lunch break just so that we can have enough time for that. So I will see you back here at 11:55. Thank you.